Hi and welcome to another edition of Top Tips Tuesday. Jeff here again from GCD Property. So this week's tip is for property investors. Should an investor avoid negative gearing? There's a lot of answers to that. I think it's a very bold statement, and I've owned negative gearing property in the past, and sometimes it is the right way to go. So don't discount that, but understand how it's going to impact your cash flow. Number one tip is, what is negative gearing? So for those new to property investment, it sounds very scary. Essentially, negative gearing means we're putting more into the property than we're receiving in income. Knowing that number is really important. I've bought many properties over the years, and I've had to tip in $50 a week on average. I view it as a compulsory savings. As long as the property is growing in value, that eventually that rental income will surpass that. But it is important to understand the numbers. So negative gearing means it's costing you to hold on to that property. And again, it depends on each individual circumstance. So if you don't have any surplus cash flow each week from your income, you shouldn't be investing in negative geared type properties. So should you avoid it? Depends on the property. I've worked with many clients where we're buying these development sites, so we're buying the bigger land parcels to develop the properties, and they'll get that long-term growth from the land asset, and those properties essentially won't cover themselves because it's the value in the land. So it's a case-by-case investment. First property, I think if you're just getting new to property investment, try and find a property that can cover itself. It's neutral or positively geared is the ideal outcome. Just bear in mind, tip number 3, negatively geared property does reduce your borrowing capacity. So when your finance specialist looks at your borrowing capacity, they will take into account the rental income from that property. And if it's costing you money to own that property each week, that's going to reduce your borrowing capacity. So again, when you go to speak to your finance specialist, they will ask you those questions: what sort of price point, how much deposit, and how much rental income will come in for the property. So you need to know all those numbers. That's the big key, is really understanding the cash flow before you make a decision on the investment property. Don't get excited, just go and view a property and buy it because it looks okay. You really need to understand the numbers. Generally speaking, if you're new to property investment, I would suggest avoiding older high maintenance properties. I've had those in the past myself, and they can be very costly and time consuming as well. I was in the building trade, it wasn't too big an issue, but those older properties can really drain your cash flow reserves and take a lot of time away from your lifestyle as well. So again, modern low maintenance type properties will generally give you a better outcome. And tip number 5, consider the tax implications. So the ATO is pretty generous for property investors, much like running a business. Many of the expenses related to that property can actually be a tax deduction, and there's one of the big tax deductions is known as depreciation. So one interesting thing about depreciation to understand is, on a brand new property, you can claim depreciation on the fixtures and fittings, so all the internal sort of fittings. But once that property is more than 1 day old or been leased out, you can't claim those tax deductions. And that can quite dramatically affect your cash flow. Depreciation, it's not a cost that you pay, but the great thing is you can actually receive it part of the back of your tax break. So that tax refund that you may be entitled to for that property may help guard you against the negative gearing and help your cash flow. So those properties that are eligible for depreciation will really increase the income. So it's looking at all the numbers, all the figures, and looking at the net outcome per week and making a decision based on that. So I hope that's helped. If you need any information about the numbers and the cash flow like the properties we're talking about, welcome to reach out, because I can actually run you through and show you whether that property is going to be positively or negatively geared in a very detailed cash flow forecast. Hope that's helped, and see you next Tuesday.